You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, interest rates are going at least 50 basis points higher imminently. Fed Chair Jerome Powell has made that abundantly clear. They're going up for the foreseeable future. When is the pivot coming? Is the pivot coming? But more importantly, what does it mean now? What is going to happen to the economy, to housing, to your portfolio? That's what you really care about. And with us now is financial expert Anthony Saccaro. Anthony, great to have you back on the show. So as a student of the economy, Fed watcher, what's your take on what's happening now with the Fed and the economy, not just in the United States, but globally?
Yeah, hi, Kerry. Thanks for having me back on FSN. Definitely appreciate it. You know, we're in an inflationary cycle. I know that's news to everybody watching, right? We know that. But the reality is that inflation had peaked at 9.1% last year. It's dropped down to our current rate of 6.4, but the last few readings have been in the sixes. So it's still high. It has come down. Jerome Powell has indicated in no shortage of terms that they're going to continue raising interest rates until they get it down to their target of 2 or 3%. What that means is that they're probably going to drive the economy into a recession. Powell's not denying that at this point, but he is basically saying that there's going to be pain either way. There's going to be pain for letting inflation run out of control and run rampant and stay at these high levels. And there's also going to be pain in continuing to increase the interest rates, which means it increases the cost of living for consumers and cost of doing business for corporations. There's going to be pain there, but that's going to be a less pain than if they were to let inflation run wild. So they've decided that driving the economy into a recession is going to be the lesser of two evils.
Yeah, well, I think it's more of the evil of the two lessers, but you don't have to worry about it. Just like inflation was supposed to be transitory, I'm sure a recession will be transitory too.
Yeah, that's the question. I believe there is going to be a recession. The question is, when is it going to start? How deep is it going to be? How long is it going to be? Is it going to be short and shallow, or is it going to be, long and deep? And I think the longer this battle for inflation goes, the greater the opportunity and potential for it to be longer and deeper. I don't think that we're talking recessionary times here in 2023. I think we're probably now pushed out to 2024, simply because of the fact that the labor numbers are so strong. It's the workforce participation. It's the low unemployment, historically almost uncomfortably, dangerously low unemployment, that is actually keeping inflation as high as it is. So unemployment's going to have to go up. Jerome Powell recently said that, according to their numbers, it's going to have to get close to 7% in order for inflation to come down. So ultimately, Kerry, you're going to have a lot more people out of work. And inflation will come down, but that's going to cause a recession.
Yeah, well, the one thing, though, is as rates go up here, the dollar gets higher. It's attracting more and more capital from overseas because there is no other place they can get a return, even in Europe. And with the war going on, with the European banks being on the skids, it's really could have a negative. Could actually wind up accomplishing the opposite because, granted, the money supply starts really decreasing, that could be an issue. But as more money flows into the United States and as rates get higher, dollar-denominated debt becomes more expensive to those countries overseas, and then they start collapsing. We're seeing this all over the place. And really, will it have the desired effect is the question. And I'm not convinced that it will.
Yeah, I'm not convinced that it will either. And of course, with the strong dollar, that makes everything more expensive for the importers from other countries as well. Not just the interest that they're having to, that they're paying. It's everything. But you also have to look at it from an internal standpoint, from an American consumer standpoint. The strong dollar has really offset the inflation as well too, because it means that the imports that we're bringing in from China and these other companies are actually less expensive to us. So a strong dollar has dampened the true effect of inflation. And that's something that I think is not talked about a lot. Yes, inflation was 6.4% because the dollar is so strong. We're not feeling it to the full extent. Now, you talk to your average everyday consumer, Kerry, and you know that they're feeling it. But here's the scary thing. They're not feeling it to the full extent because the dollar is strong.
Hey, as long as you can substitute spam for steak, what's the big deal, right?
Yeah, that's exactly right. And, unfortunately, there are a lot of people that are doing that. And what I'm afraid of as well, I mean, there's a lot of wealthy people in this country that, inflation to them, these baby boomers with multiple millions of dollars in their portfolio that really don't have to worry about inflation to the degree that maybe 20 or 30-year-old blue collar worker does. For sure, there's a significant difference, but the wealth effect or the negative wealth effect is going to kick in when, in fact, the recession hits. When things start to go down, when you see your portfolio start to go down, you're not going to feel like spending money. You might have $3 or $4 million in the bank or in different investments, but you're not going to feel like spending it. And so all these people that could be spending money, should be spending money, what they're doing is they're cutting back on their lifestyle needlessly because they don't feel like spending it. And that's just going to add to the recession. And the further the recession goes, the deeper it goes, the more the negative wealth effect kicks in. So it's this kind of this vicious cycle where the recession is going to cause a greater recession, and not just among the people that it's really hitting hard, but also among people that just don't feel like spending money because they're not feeling great about the economy and themselves.
Yeah, well, when your stock market portfolio goes up every day, you can feel real generous. You can make more charitable contributions, take more trips, buy more useless crap from China, whatever gets you off. But when you see your portfolio value go down, then, like you say, the reverse wealth effect kicks in. And if you're insecure about your job, you're much less likely to spend money, at least you should be, than if you feel your job opportunities are secure. The question is, are we going to see a market crash in the second half of 23? What do you think?
I'm not sure if it's going to be in the second half. There's definitely going to be some pain to come, for sure. Whether it's in the second half of 23 or 24, I'm not sure. I would say 23 is definitely up in the air, or definitely up for grabs. It absolutely could happen. What I think is going to happen, Kerry, is something's going to come out that's going to spook the market, that's going to trigger an avalanche. I think there's a lot of things that have been going on that have been, these snowballs kind of rolling down the hill, the ski slope. But at some point in time, there's going to be a negative CPI report or an extremely positive jobs number or combination of everything. And the reality is that something at some point in time, from what we've seen in history, you and I have been around long enough to see that something spooks the market. And the next thing you know, you throw a little pebble at the snow mountain and it causes an avalanche, and now you can't stop it. And that's what happened in 2001 with the tech crash. Back then it was I think Arthur Andersen, right? That the accounting for that company and exactly. And then you go back to 2008, it was Lehman Brothers. Well, guess what? Right now, corporate debt is through the roof, right? Because of all the stock buybacks, companies have been buying stocks. They've been financing it with debt because rates have been so low. And if we have one of these companies that goes BK on us, then all of a sudden that could be the impetus, like the Lehman Brothers was for the 2008. And I think something could turn very quick, and I think it's going to catch a lot of people with their pants down. And like Warren Buffett said, you don't know who's swimming naked until the tide goes out. And I think that's a picture, right? But I think the fact is that I think the tide's going to go out, and something's going to cause that avalanche. It's going to happen very quickly, and a lot of people are going to get caught off guard. And I think in 6 months or a year from now, Kerry, there are going to be people saying, I wished I would have. When the market was only down 10%, I wished I would have got out. And we've seen it. You and I have seen it before.
Oh, yeah. There's nothing new here. It seems to me we're going to go up. Right now we're having It's going down, going to go up at least one more time, getting close to previous highs, and then it's going to go waterfall. Every financial expert I'm talking to, every market technician believes that that's what's going to happen here.
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
Yeah, I agree. I agree. I think that is what's going to happen. But when you look at the history of the market and the past couple of major crashes that have happened, particularly 01 and 08, people, 08 gets the credit for it. But the crash of 2008 that really happened towards the latter half of 2008, that crash started the decline started in May of 2007. So it had been on a downward climb for a year and a half before the actual crash happened. And we're there. We're on that downward decline at this moment. We've started last year on the downward decline. Now we've bounced up a little bit, but it's almost like an airplane that's coming down for a landing. It's not just going to go on a straight line. It's going to be bounce ups. And we've had a little bounce up, and we have a lot of people that we've been talking to that have gotten some of their money back and are becoming clients because they're saying things like, we got a little bit back. I'm not going to lose it again. And they know that the worst is coming. So it's a good time to make a shift if in fact that's what, when someone's thinking about doing it.
So you make the shift. What then? Where do you shift to?
Yeah, great question. I get asked this question all the time. And that is, I recommend investing for things or in things that you can count on. Right now, if we're talking about stocks, if you have a stock portfolio or you have a mutual fund portfolio, you have no idea what your portfolio is going to be worth in 6 months or a year or 5 years. There's no way of knowing. It's your crystal ball versus my crystal ball. But there's a whole universe of options out there, Kerry, that are designed to give you interest and dividends. And when you invest for interest and dividends, as long as you work with an income specialist like we are here at Providence Financial, the fact is that you can count on your income every year. And now investing is not by crystal ball, but it's more by math, investing by math. When you get a 5% interest dividend coming in every year, you can count on it. You can either spend it if you need it or reinvest it. And it doesn't matter what goes on with the markets, what happens in the geopolitical world. None of that matters. Invest for what you can count on, interest and dividends.
All right. So you got to go for cash flow.
100%. And if you don't need it, dollar cost average. Dollar cost averaging is what's made most baby boomers wealthy. And if you have a growth portfolio with no dividends, there's nothing to dollar cost average. At least if you're getting dividends, you can dollar cost average, over time, even if you don't need the money, and you'll still come out ahead on the back end, whenever that back end is.
All right. Well, so you average up, you average down, but always keep averaging, right?
100% and dollar cost averaging. Yep. Don't quit that. And you don't have to quit that in retirement.
Right. Sure. And it's just a question of your needs. Hopefully you won't need to take the principal of your investment. You can live off the returns, but we all know we're not going to live forever. At some point, not such a bad idea to take the principal when you need it, when you get old enough and life expectancy and all that. Hey, so what about what they're talking with Social Security now? Do you really believe that there's anything they can do other than raise the retirement age?
Well, there's a lot they can do. Social Security is a political issue more than a mathematical issue. When you listen to the media out there, you hear them say things like, "Oh, it's going to go broke. It's going to go bust." In 2034, there's not going to be any Social Security. Well, the reality is that when you look at the trust fund and even you look at the front of your Social Security statements, it's not going to go bust in 2034. The worst case scenario is that everyone loses 21% of their Social Security. So Now, don't get me wrong, you're not going to have seniors that are happy when their Social Security gets cut by 21%, but that's
and they're the voters too, right?
That's right. So, and that's why no one wants to tackle it, but it's not going to go bust. But they can raise the retirement age. They already have done that. I think they should do that. I mean, 70 is the new 60, right? When Social Security came out, Kerry, 1935, the average life expectancy was 67 years old. So you weren't supposed to be collecting Social Security for years and years. Now people today are living 20 years, 30 years. I met with someone 6 months ago who the first person I ever met with that's been retired longer than he was working. And that's going to just become more commonplace. So I agree that they should move the Social Security age, but they can also increase the taxes. Right now, Social Security is taxed for employees on a certain amount. I want to say it's $117,000. I'm not sure 100%.
18,000.
Something like that. But if you live
up.
dollars, if you make $1 million, Social Security is only taxed on the first $117,000. They could increase that limit. They could increase the employer's limit. There's a lot of ways that they could solve the problem. It's not a mathematical problem. It's a political problem. And knowing how Congress and the government works, they'll solve it in the last week of December in 2033.
Hey, well, we got plenty of time, right? Except
that's right. And that's all they're doing is kicking the can down the road.
Yeah, well, none of those solutions that you've outlined really get to the bottom of the underlying problem, which is it's poorly designed. It puts off awful returns compared to alternatives, and it's mandatory. It's forcible. Whether you're Warren Buffett or you're Kerry Lutz or Anthony Saccaro, you got to pitch into it. Even though you might have already hit your maximum, you're still paying into it as long as you're getting a salary, and that leads people to do everything they can to avoid being traditionally employed here, right?
Oh, 100%. Yeah. I mean, it's it's a social system. It's called Social Security, right? So, you do have to pay into it, and it does have those negative effects as well too. But the flip side, Kerry, is that I'm not convinced that consumers or average everyday Americans would be saving on their own if there wasn't Social Security. You think about defined benefit versus defined contribution plans, and the defined benefit plan has gone by the wayside now. And the government, because of all the regulations, have basically forced everybody into defined contribution plans. And all the studies show that defined benefit plans were better. People were saving. Well, they were forced to save as opposed to putting that power in their hands. And I think 40% of Americans or 40% of retirees would be broke without Social Security. So as mandatory as it is, as much as you and I don't like to be forced to, put into it, and then we're at the maximum numbers and you got to keep paying into it anyway, although there is some structural problems behind the scenes, I think most Americans are actually benefiting from it. But I agree, they're spending the trust fund money. They weren't supposed to touch this money. That money's gone. It's become a Ponzi scheme. Today's dollars are being used to fund the future retirees, and that's definition of Ponzi scheme.
Whereas you look at the Chilean experiment, which is a privatized mandatory national retirement insurance program, it's put out huge returns. I haven't seen any statistics on it lately because they don't want to talk about it, because they don't want you to believe that there's actually an alternative towards what they're throwing you into. So, but in Chile, they're first privatized. The economy has boomed. The standard of living has gone up, and people are retiring with more money in their retirement than they were making during their working years. And I guess that's just something we don't want to have happen in the United States.
Yeah, why would you want that to happen, right? Maybe we should move to Chile. But yeah, I agree with you. And, in California, it's even worse. In California, where I live, they're doing everything they can to put businesses out of business. It's very difficult for employers to employ people without having to worry about getting sued. And yeah, the governmental regulations, all of that is having a negative effect on the economy as well. And that's part of why we haven't had more than 2% growth, GDP growth over the last decade and a half as well, too, because of some of the regulations. So,
and the government's taken too big a slice of the pie. It's like you invited relatives over and you say, we're just going to have a snack. And the next thing you know, they're raiding your refrigerator and your freezer and eating you out of house and home, the very definition of a parasite. And that's what our government's turned into. It's a parasitic entity that has no limits to its appetites and its ability to raid your kitchen and take all your food. Well, Anthony, we want to find out more about you. We want to connect with you on the internet, the interwebs. Where is the best place to find you and to get your book?
Yeah, so I think a good starting point is my website, anthonysaccaro.com. From there, it kind of branches out to my law firm, my financial firm, and you can buy a copy of my book right on that website, More Life Than Money. AnthonySaccaro.com. It's 2 C's, 1 R. Anthony, SACCARO.com.
And there's a link to it in the show notes to this interview on financialsurvivalnetwork.com. Make sure you go sign up for your free newsletter. Hey, questions, comments for Anthony, myself, email us kl@kerrylutz.com. Anthony, always great having you on the show, and we will catch up with you soon.
Kerry, thank you for having me. Appreciate being here.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.